Welcome to our lecture series on international financial management. Today, we will talk about risks involved in international trade finance. International trade finance facilitates global commerce by connecting buyers and sellers across borders through a network of financial institutions, payment mechanisms, and credit arrangements. However, these cross-border transactions introduce a wide array of risks, often more complex and severe than those encountered in domestic trade. Understanding and effectively mitigating these risks is paramount for managing international trade and financing operations. International trade involves multiple parties, jurisdictions, and regulatory environments, creating layers of uncertainty that contribute to various risk categories. Risks involved in international trade include commercial risk, credit risk, foreign exchange risk, country risk, political risk, transfer and convertibility risk, legal and regulatory risk, transportation and logistics risk, documentation risk, market risk, cultural and communication risk, and force majeure risk. Commercial risk arises when a buyer or seller defaults on contractual obligations, fails to pay, or delivers defective goods. Credit risk specifically refers to one party's failure to meet financial commitments, such as payment on open account or under documentary collection. Foreign exchange risk stems from fluctuations in exchange rates between the contract and payment dates, where a weakening buyer's currency increases payment costs. Country or sovereign risk involves political instability, changes in government policies, or nationalization that can impede contract fulfillment. Political risk includes government actions like expropriation, sanctions, trade embargoes, and restrictions on currency conversion or repatriation. Transfer and convertibility risk occurs when a country restricts foreign currency transfer or conversion, making fund repatriation difficult. Legal and regulatory risk arises from differing laws, contract enforcement standards, customs, taxation, and documentation issues across countries. Transportation and logistics risk covers damage, theft, loss, or delays of goods in transit, as well as insurance and shipping route problems. Documentation risk involves errors or discrepancies in trade documents like invoices or bills of lading, which can delay or void payments. Market risk relates to fluctuations in commodity prices, interest rates, or demand that impact profitability. Cultural and communication risk stems from misunderstandings caused by language barriers or differing business practices. Force majeure risk includes unforeseen events like natural disasters, pandemics, or wars that disrupt trade operations. Beyond general trade risks, international trade finance introduces specific risks due to financial intermediaries and instruments. Risks specific to international trade finance include credit risk, operational risk, compliance and regulatory risk, fraud risk, liquidity risk, interest rate risk, reputational risk, settlement risk, country and transfer risk, technology and cyber risk, legal enforceability risk, and sanctions risk. Credit risk is the risk that the importer or exporter defaults, leaving the bank with unpaid obligations. Operational risk is the errors in transaction processing, documentation, or communication between banks and clients. Compliance and regulatory risk is the exposure to non-compliance with anti-money laundering, counterterrorism financing, and know your customer regulations. Fraud risk is the risk of forged documents, misrepresentation of goods, or false shipment claims that can lead to significant financial loss. Liquidity risk arises with a bank or exporter facing short-term funding shortages when financing trade transactions. Interest rate risk arises from changes in interest rates that can affect the cost of financing and profitability of trade loans. Reputational risk arises from involvement in controversial transactions, corruption cases, or non-compliance with sanctions. Settlement risk is the risk that one party delivers payment while the counterparty fails to deliver the corresponding currency or goods. Country and transfer risk arises when governments impose restrictions that prevent completion of financial transactions or limit foreign currency availability. Technology and cyber risk expose trade finance systems to attacks and data breaches. Legal enforceability risk arises with disputes over documentation or jurisdiction that can make enforcement of trade finance contracts complex and costly. Sanctions risk arises with transactions inadvertently involving sanctioned entities, or countries can result in severe legal and financial penalties. Effective risk management requires identifying, assessing, and minimizing the impact of these risks using both financial and operational tools. Mitigating risks in international trade include letters of credit, trade credit insurance, export credit agencies, currency hedging, due diligence, diversification, international commercial terms, insurance coverage, strong contractual agreements, and using reputable banks and intermediaries. Letters of credit provide payment security by involving banks as intermediaries, ensuring payment upon delivery of compliant documents. Trade credit insurance protects exporters against non-payment, while export credit agencies offer government-backed guarantees and financing. Currency hedging uses forward contracts, options, or swaps to lock in exchange rates and mitigate foreign exchange exposure. Due diligence involves assessing buyer creditworthiness and country risk, and diversification reduces dependency on single buyers or markets. International commercial terms clearly define responsibilities between buyer and seller, and strong contractual agreements include arbitration clauses and governing laws. Insurance coverage for marine, cargo, and political risks safeguards goods and payments, and using reputable banks ensures compliance and reduces fraud. Enhanced due diligence, blockchain, and digital platforms improve transparency and reduce fraud through immutable transaction records. Structured trade finance, syndicated trade loans, and risk-sharing agreements manage large exposures and reduce credit and liquidity risks. Automation and compliance software, along with continuous staff training, detect errors and prevent fraud, ensuring regulatory adherence. In conclusion, international trade and trade finance risks are inevitable but manageable. By identifying potential threats and implementing comprehensive mitigation frameworks, firms and banks can confidently conduct international business. Effective risk management, leveraging financial instruments, legal safeguards, and technology is a cornerstone of global financial stability in our interconnected world. Thank you for watching our lecture on international financial management, focusing on risks involving international trade finance. See you at the next lecture.